Thank you for watching our reverse mortgage educational videos up to this point. My name is Parker Turk. I'm with Sun American Mortgage Company. I'm a CPA and somebody who's been working directly with reverse mortgage clients for 10 years. As a CPA and with a financial planning background, there's certain aspects of the reverse mortgage that are much more fun for me to dive into. You know, the first 20 years that we wrote reverse mortgages here at Sun American, it was pretty typically for a specific candidate. We were usually looking for somebody who had already spent through their IRAs, spent through their 401ks. They didn't have any savings left, and they had their house, and they had the equity in their house. Those people used the reverse mortgage for what we used to call the loan of last resort. People had already gone through everything they had. Now they needed to lean on the equity in their house just to make ends meet. And for the most part, it worked out great for those types of people. Those people were able to add these closing costs of the reverse mortgage to a loan balance. And in the end, they'd say, well, that's just, $10,000 less that my kids get, but I need the money now. And so in the early days of the reverse mortgage program, there were hardly any financial planners who would ever advocate a reverse mortgage strictly because of one thing: closing costs. The flexibility of the program was always great, and I'm going to explain a little bit about that today. But the closing costs were exorbitant, and that caused people to not look into the program any longer, strictly because they didn't want to incur $10,000 or $15,000, sometimes $20,000 right up front if they didn't really know how long they were going to live in the house. Well, a couple things have changed over the last 5 to 7 years. The interest rates have dropped, the home values dropped with it, and now have started to come back up. But the government has made a few different changes to the program that have financial planners really looking at this from a whole different light. Within the last week even, the Wall Street Journal, Forbes magazine, different publications that are well respected are starting to look at the reverse mortgage and saying, hey, why are more people using this not to pay off large debt, not to use it as it's typically been used in the past, but as an extra bucket of tax-free cash that they can set aside, let grow for them, and use if and when they need it. I'm going to explain right now why more and more people are starting to use it that way. It all starts with the closing costs. So because of some of these changes, the closing costs have now fallen. If you don't need to use all of the reverse mortgage money right up front, then the closing costs just fell in some cases 5 times. And what that's allowed people to do is set up lines of credit. A lot of people go down to their local bank and get a home equity line of credit just as a backup plan. If and when they need money, they know they can go get it from a line of credit. Well, there's a problem with a normal home equity line of credit. If you take money out of a home equity line of credit, you have to make payments on it. If you take money out of a home equity line of credit and your home value falls and interest rates rise, you could actually be somewhat stuck, because if you ever needed that extra money that's in that home equity line of credit, when your home value falls, the banks will come and freeze the line of credit. So what the reverse mortgage does that these other home equity line of credits don't do is it's guaranteed by the government to always be there and to always grow. What I wanted to show you is kind of an example of what would happen if we set up a line of credit for somebody. And I've tried to kind of make this on the whiteboard look like a HECM statement. Now, HECM stands for Home Equity Conversion Mortgage. That HECM here at the top is really just another way of saying reverse mortgage. So let's take, for example, a couple who comes to me and they have a $400,000 house. And they just have a small mortgage left, maybe $20,000. A little home equity line of credit that they already had, or they had just got to the point where they've nearly paid off their house. Most people in the past wouldn't have looked into a reverse mortgage, but now that the financial planners are touting it, they're coming to me and saying, why would we get one? Let me show you why. See, if you have a loan balance of $20,000 and we pay off $20,000, and in the meantime, let's say that these people, they must be around, 70 years old. They would have access, like we've kind of taught you in some of the other videos, they would have access to a percentage of their home's value. In this case, they have access to $220,000, but they don't need all the money. All they need is 20 grand to pay off the existing mortgage. So what we do is we do a reverse mortgage, we pay off the existing mortgage, and now we've set up the rest of the money in a line of credit. Now I don't know, interest rates will change with home equity lines of credits because in most cases they're adjustable interest rates. And so what I did was I just picked a number, this isn't today's rate, but 5%, for example, would be the interest rate that you are charged on any money that you take out of a line of credit. So if we take $20,000 and pay off your existing mortgage, then $20,000 is in the loan balance, and every month you get this statement, and it would say we're adding 5% interest annually to your loan balance. In 1 year's time, it would be roughly $1,000 right here. So your loan balance just went up in 1 year's time to, let's just say, $21,000. In the meantime, this extra bucket of tax-free cash that's sitting off to the side in the line of credit is growing by the exact same interest rate. And some people say, well, why would the government do that? What's the point of that? They're not doing it out of the goodness of their hearts. They're doing it because they know you're getting older, and they're doing it because they're betting on home values going up. So for both of those reasons, they're going to grow this equity that you have access to. They're basically unlocking more of your home's equity over time. And so in that same time period, if your $200,000 line of credit just went up by 5%, then now you have the ability to pull tax-free cash that you do not have to make payments on of about $210,000 after 1 year. Now, a reverse mortgage line of credit does everything that a normal line of credit does. If you ever wanted to make a payment on this, you could. If you wanted to pay the $1,000 every year, you can. If you paid this $1,000, then your balance would stay at $20,000. Not only that, but the $1,000 you pay would shift over to the line of credit, and you now have access to $211,000 for you to use tax-free cash that you can take in and out whenever you want. The reverse mortgage program is very flexible now because now we can do this and the closing costs stay low. Financial planners like that for 3 reasons. One, they really like the fact that this is tax-free. As a CPA, that rings all sorts of bells in my mind. It gets me going and says, you know what? There may be some tax planning strategies that you can use. Rather than pull all of this money from a 401k or an IRA now to do this, that, or the other, maybe we should supplement what we're doing with some of this tax-free cash to keep the tax bill low and continue to defer taxes. The other reason is that this growth on this side happens regardless of what the environment is. So if we're going through the second Great Depression and your home value just fell in half, they're still growing the line of credit. It's backed by the full faith and credit of the U.S. government. And so as that grows, even in an environment where your home value has fallen, you're safe in knowing that you can lean on this equity if you needed to. They can't freeze it, they can't stop the growth, and so it's the ultimate equity insurance. If you get this reverse mortgage, you set the line of credit aside right now, even if you don't need it right now, 10 years from now when you may need it, or 10 years from now when we're going through a recession, or 10 years from now when you lose a spouse, or whatever the case may be, you're going to know that that line of credit has grown over the past 10 years. That's the second reason. The last reason is really pretty interesting, and this is what financial planners really like, is they use it as a portfolio protection product. What I mean by that is, inevitably, our markets go up and down, and you never know when you're going to need the money from your retirement accounts, or land, or what other assets you have. What really lowers people's net worths is when you need money from your retirement accounts, or you need to sell land, or you need to sell rental properties, or you need to sell whatever, because you need to live off of it in a time when things have really dropped. So for example, you need money in 2008, 9, and 10. Well, at that time period, the stock market was at all-time lows, land values, your home value was at all-time low, and rather than going out and selling at that time and lowering your net worth in half from where it had been just a few years later, why not take a little bit of money from the line of credit? You're not going to have to make a payment on it if you don't want to, and it's tax-free, so it's not going to bother your tax bill. And in the meantime, what you've allowed to happen is you've allowed that extra money that you've had invested, the land, what other assets, to grow back to where they were and potentially even further. And so financial planners right now look at that and say, why would I let you come and take this money out in a real bear market, when things are down, when you could supplement your income, allow things to grow back, and if and when you sell these assets in the future, stocks, bonds, land, well then you can come back here, and if you wanted to, you could pay it right back down into the line of credit. So I know this has been a long video, but I hope you listen closely, because what I'm basically saying is there's nobody, and I mean nobody, who has a home paid for free and clear or has a small mortgage that right now shouldn't really strongly look into this. The reverse mortgage line of credit is pretty robust. It gives you a lot of opportunities in the future, and it guarantees that you will have, it gives you the best option to not outlive your money. Thank you so much for watching this video today. I hope you learned a lot from it. I know that you probably have questions, so I want you to call me. Call us here at Sun American Mortgage. The phone number's below. You can fill out a lead online. We would love the opportunity to put your information into the calculator and kind of explain the different programs, the pros and cons going forward for you. So we really hope to hear from you soon.